What's up, everybody? We are back. Episode 51.
Another live one
of the More Doors podcast. And we are live in the house.
Get used to it.
Should we?
I like to.
Apparently, Brian thinks so.
I like doing it live. It's fun.
Hmm.
It's fun. Anything can happen.
Matt,
choose your own ending.
Yeah. What's the topic about today?
Today, we're going to talk about how the recent stock market fluctuations and volatility are impacting or could impact the multifamily market. And I think we're going to talk about it from two perspectives, right? One, the investor, and two, the
non-investor.
Thank you.
The operator.
I had total brain fart there.
It's because we're live.
It is.
Yeah.
I'm totally on the spot.
You are. Well, I'll take it with you then. So, but first, before we dive in, check out our sponsors, the people that make all this happen, starting with Deep Blue Capital. Go on over to deepbluere.com if you want to learn how you can build wealth, passive income. Check out the projects that we're working on. We've got some great things in the pipeline. Go create your investor profile, and we'll connect with you, learn more about your wealth building goals and how we can help you reach them. When you're done with that, go check out tourstudios.com, the home of Jesse and all this awesome stuff that we got here for all your multimedia needs, whether you're creating YouTube videos, Facebook, Instagram, Reels, all that type of stuff. Jesse's got you. Check out tourstudios.com.
Before we get started, can we just say how great of a party Deep Blue throws for our investors?
Bro.
And thank
My
you
entire
to
Saturday was reminding me how much of a good time I had on Friday.
Yeah, you had a great time. I had to cut it off because I had to drive. I didn't have my DD there this time, and I was one away from like, I'm gonna have to leave the truck here.
I was trying to talk you into it.
You were, yeah. Thankfully, you were unsuccessful on that one because that would have made me feel bad on Saturday, like you were feeling. But let's give a shout out to Mexican Bar Company.
Oh,
holler.
Yeah. Plano, Texas.
Plano, Texas. They do an amazing job of taking care of us and are making our people there feel just absolutely amazing. And they have the best food hands down. Like every time we go there, we're just blown away by the service and the food. So
good.
And they have an amazing añejo old fashioned. See what I did with the thing on the end?
Yeah.
I like that. That's very professional.
Those are the talk of the
you get a Hispanic fiance, and then you just really start enunciating.
I speak more Spanish than she does, bro.
Yes, I believe that. That is probably true. Ooh, how are the portfolios looking right now, boys? We're talking about the stock market correction and possible one, but today, to the moon, Jesse, we're coming back. We're coming back, but it might be short-lived. Thursday, Friday, and Monday were rough.
With two Fs.
Rough with two Fs. The Nikkei, is that how you say it in Japan? 12% loss, the worst since essentially Black Tuesday in 1987.
Correct.
But did you see on Tuesday, they rallied 10%.
Nobody knows what's happening. Welcome to the global economy where everything's made up and the points don't matter. There was no White Wednesday after Black Tuesday in the 80s, but with this level of volatility in the markets, there's a general speculation, and rightfully so, that we are in for a stock market correction for a few reasons. One being that it appears that a large percentage of this rally that we've been seeing all the way through this higher for longer rate scenario has been fueled primarily by the Magnificent Seven. 7 stocks have been carrying the entire market this whole time. And so when you rally like that off of essentially sentiment, there's been a little bit of an AI bubble brewing and stuff like that. The fall tends to be a little bit bigger because the market might have been a little bit propped up. So I don't want to speculate too hard. I really would rather talk about a scenario in which the stock market did correct without me trying to put my crystal ball out there. I think it's very possible, though. And so if the stock market really does see a significant correction, and I think we measure correction as anything over a 10% drop, what does that do to the real estate industry and space in general, and specifically multifamily? What does that look like? And I think that's one of the things that is the topic that we're covering today from a whole lot of different angles. First off, I want to start maybe with this. Nick has been talking about this for a little while, and Jesse, you can pull this one up about. I sent Jesse a whole bunch of links, Go to the one on the far right. This is, I think, a really good indication of where we stand as a society in terms of our ability to pay even our own personal and consumer debt. This is very important. We have a record high number of people taking early distributions from their 401k and paying the fee. We have more people doing that than at any point in history right now. And it seems like they're doing that obviously because of inflation and because their consumer debt is higher than their wages allow them to pay down.
Well, and the reason why, just if you can bring that back up, I know we're having trouble bringing it up on the screen right now, but when you take an early withdrawal, you have to cite the reason, right? So what was the percentage of people taking it out? So it was a large percentage that the reasons why they were taking it was a hardship to pay either their mortgage or to pay for rent, right? To hopefully, hold off from being evicted or losing their home in a foreclosure. And so a lot of this has to do from the single family side is that property taxes and insurance have gone up. Obviously, the cost of just living has gone up. Wages haven't. We're starting to see unemployment. Obviously, the unemployment numbers that came out where are not great if you're looking for a job. They're not great if you're, wanting to keep your job because there's a lot of volatility in that. And then ultimately that leads into people not getting raises and it starts to dip into their savings.
Yep.
Do we have any stats on that? I'll pull it up real quick if I can find it, but I know that people are really starting to dip into the savings that they were building up during COVID.
Yep.
And we're kind of getting back into that kind of, sound the alarms, alarm bells going off from they don't have enough to kind of continue any type of emergency fund.
Yeah. I mean, I'm sure the stats on people dipping into their savings is high if we have a record high number of people, record high number of people dipping into their 401ks. And so when you talk about the mortgage aspect is very interesting. Because obviously we talk about mortgage payments, we talk about PITI, principal, interest, taxes, and insurance. So if my interest rate is locked in, my taxes and insurance are a moving goalpost every single year. And those have skyrocketed across the board. Insurance and property taxes, we live in North Texas. Property taxes have become a huge burden on especially investment properties where you're negative cash flow on a lot of stuff right now on single family homes. Another reason we love multifamily, but even the individual homeowner. If you bought in the last few years, you bought even in 2021, your property taxes and insurance have absolutely climbed since then to the point where it may be unaffordable because wages have not increased at the same rate. And so if I'm taking money out of my 401k to meet that payment, I've got to start to think that a couple of things are possible with the single family market, which then has implications for the multifamily market. I probably also, if I bought in the last 5 years, I feel like I have a substantial amount of equity in my home because prices have run up a lot. Now, the flip side of that is that equity true equity? Meaning if I have to sell because I can no longer afford my mortgage payment because property taxes and insurance have gone up so much. And that is also true for a lot of other people. And we all start to run in that same issue at the same time. There's going to be a lot of supply that's going to be coming online because people do need to sell. And that's going to bring prices right back down. And so the amount of equity that people feel like they have in their homes could be real. It could be only real for the first people to realize it. It might not be real for the last people out the door. That's the premise that I'm afraid might unfold in the single family space. If that does happen, I have a hunch that when it comes to multifamily, a lot of those people that sell aren't going to buy again right away. They might rent for a while. And so my first sort of thought behind this when we were really digging into the idea of what would a massive stock market correction do to the multifamily space, I think for better or worse, it probably increases rental demand for a while. I believe that if people, any significant correction is going to erase wealth off of the board. And when you erase wealth off of the board, you're normally not going and pumping more money into hard assets. So I think people are more likely to rent. And then that has implications around the amount of units coming online, which is going to start to taper off over the next 2 years. And so I think you're going to start to see an increase in rental demand. Now, what that does to rental rates, I have no idea. This is where there's so many moving pieces.
Yeah. I think there's a lot to unpack there,
it's
though, right?
Really interesting conversation.
So I've seen a lot of data specific to multifamily over the last 12 months or so that says that wages were actually growing faster than rents, right?
Okay.
And as a result, that once all this incoming supply is absorbed, that there's numerical evidence that rents can go up because people can afford them more, right? So there's that. But something that you just said, I think we could probably do a whole show on this. There's a lot of folks out there that are feeling the pinch on their home prices because of taxes and insurance, right? What does that percentage actually look like? So if my insurance were to double this year, my mortgage payment would go up by $350.
Sure.
Which is 10%
Yeah.
of what my current mortgage payment is.
Right.
Right?
It's annoying, but it's not putting you out of house and home.
Exactly.
Yeah.
Now, from a societal level, I want to know how many of those people that are saying that they're impacted by these rises in uncontrollable expenses, how long have they been at their jobs? The single largest raise you'll ever get as a professional is when you're actively working and looking and land somewhere else. So while there may be fewer jobs out there, right? I mean, that's what sent the market into a tailspin last week, right? What are those folks doing? And in the meantime, with Uber Eats and all this other stuff out there, and ways for them to make supplemental income, like how is that working out? How many folks are just saying I can't afford it versus this is what I need to do to continue to afford it? And that to me is like, I don't know if that's the entrepreneur in me speaking or what, but like there are ways to go fix those problems.
Absolutely. There's ways. Yes. And I don't know how far down the rabbit hole we can get before I get way out of my element here. You're speaking more on, supplementing and a gig economy and things like that. That's definitely true to an extent. But at the same time, how many people can be working for DoorDash at once? Don't those things dry up at some point, right? Like there's only so much space there.
Yeah.
So
I mean, there's no shortage of restaurants opening up in McKinney though. So I mean,
yeah, it's definitely a very geographically specific.
So I think there's that part. The other part is like, is accessing the funds in your 401k and biting the bullet on paying the taxes for those. Has that just become the easy route?
Is it that, or is it? Yes, it is, because if we look at, let's break this down, right? The average person, let's age in life of savings accounts in general, right? So this is one of the Market Watch guides. It said young adults less than 35 years old, this youngest group has an average savings of $20,540. Now you get into middle age, which we are all in this group here, 35 to 54 years old. These people are in their prime earning years.
Yep.
There's notable increase in savings. And so typically what we see in this is it's more than 20,000. They don't have a legit number on it. More than 20,000, but less than 75,000 in savings. Because then you get to kind of a pre-retirement age, 55 to 64. And the average savings account balance is $75,520. Then you get into like age 74 and up, 65 to 74, it's $100,250. Greater than 74, it drops down to $82,800 because you're starting to dip into a lot of that. So when we really break it down, is that in this Market Watch guide, it talks about the financial education. And typically the ones that are more financially savvy, they're going to do what it takes and they're going to save. But the reason why they're cashing out is because they didn't prepare and have emergency funds and et cetera. So that is the only option they have to kind of save that asset. Or if they're renting, then to hold off from eviction. And you bring up a good point, which is not part of the show, is that, you should always be looking for your next opportunity so that it increases your earning potential.
Yeah.
But the average American, they don't like change anyway.
Right.
So they get into a job, they get really good to it. The scary part of the scary is the unknown, which is, just like investing in these multifamily, the scary part is the unknown. And then you get into it and you're like, man, this is, it's really a lot scarier,
Right.
or this was a lot better than what I thought it was going to be. And so people don't make moves.
Yeah. It's fair. Absolutely.
Yeah. And they just get complacent.
Yeah. I'd be very interested to know how many of the folks that are cashing out their 401k or part of it early are employed versus unemployed, right? Because if you're employed, you can take a 401k loan, pay that back, and as long as you pay it back, it's tax free, and the
Correct.
interest is usually very favorable,
Yep.
right? You're basically paying yourself back.
Yep.
But
And I think that's what a lot of that stat is because you've got to name the reason why you're taking it. And so that's where they're getting that it's for the hardship, usually to pay mortgage or to hold off, from an eviction, et cetera.
Got it.
Right.
But I mean, we talk about, all right, the stock market crashed in Japan, 12%, right? Worse since 1987. Now, how bad was the crash here?
In 87?
No, just on last week.
Oh, last week, I think we were down
On-
6 at the intraday high. We were down 6% or so.
Yeah.
We
6%,
rallied a little bit.
1,100 at the worst, right?
Yeah,
1,100 points.
1,100 points on the Dow
I
at
think
the
we
worst.
closed at just over 1,000.
Yeah.
down.
So it was substantial. It was the worst since
2022.
something like that. Yeah.
Started with a 2.
I mean, there's a whole COVID skew there where we had some really bad days in March of 2020, but it was substantial.
Sure. And so let me ask you this. The assets that Deep Blue have, how much money did they lose that day?
To the best of my knowledge, $0 in lost value.
Right.
Yeah.
So,
Good.
yeah, it goes to as an operator. And then I want to ask you, Matt, from the investor side of things, because like there's two sides to this coin, right? So as an investor, you're putting your investment, your disposable income that you have available to invest in a project into an asset that you don't want to lose money, right?
Yep.
The goal is in 3 to 5 years to sell it and to earn dividends and to hopefully double your money, whatever the payout's supposed to be.
Yep.
From an operator standpoint, it's the same thing,
Mm-hmm.
and earn management fees, et cetera. So we weren't looking at last Thursday as a negative to our assets. I wasn't looking at Bear Crossing and the Haley and it lost 10%.
Right.
Right.
I was certainly watching my, Schwab app. That was fun.
Yes. And so it's different in general. We know that we're holding that asset for 3 to 5 years minimum anyway.
Right.
So we hope that in the next 3 to 5 years that the market is good enough for us to dispo that asset and it hits the investor returns that we've been projecting.
Exactly.
And it goes exactly to what we were just talking about with 401ks and things like that. So the average American has so much of their wealth tied up in either their primary residence, which is great, or these retirement accounts that are for this unknown point in the future where that's going to be what you live off of. But you are absolutely just at the mercy of a market that is not designed for you to win at all.
What if you were, I'm 41, Matt, how old are you?
45.
45. So we're, Brian's 37.
Yeah.
So we're closer to retirement than Brian is per this chart. I mean, if we were
Depends on when I just want to stop working and move to Thailand. So
yes. Yeah.
I could be way ahead of you guys.
It's a whole different podcast episode. But if we had all our money tied up in the stock that was used for retirement, we would be freaking out about last Thursday.
Yeah.
Mm-hmm.
Right.
Yeah.
2008 wiped a lot of people out that were right on pre-retirement age.
Yep.
And they had to work through it in order to regain what was lost. Now, if time's on your side, that's great.
Yep.
Right. Everyone talks about the only time you lose is when you sell. But when you're at retirement age, you don't have a lot of time left.
Yeah.
Right.
That's actually a fun little thought experiment, Jesse. If you could pull this up, I want to just really quickly do an S&P chart, and we'll go back from 2008 and see how long it took to come back. We'll just use kind of an S&P chart as, if I had all my wealth tied up in the stock market, how long would it have taken me to get back to even? And we'll use that same chart. This is not a perfect representation, but this also would account for single family homes as well. Single family homes lost a tremendous amount of value between 2008, 2010, and it took a long time for people to recover their equity if all they really had their wealth tied up in was either their primary residence or single family homes, because single family homes are valued completely differently than multifamily assets. So from peak to trough, right? Let's say 2000, where's that? Late 2008. Is it September of 2007? Okay, now let's draw a horizontal line right across. When was the last time we got back to? Oh man, yeah. So about where are we at? Yeah,
Around probably December
of 2013.
Or
So
12.
12. So 5.5 years or so it took.
Yeah.
So
But that was a cataclysmic event, though.
Oh, sure.
Right. I remember I was out fishing and watching CNBC 100 miles offshore, wondering if like the place was going to be burning when I got back to land. Right. But you had banks failing.
Yeah.
The adjustable rate mortgages, housing became completely erratically overvalued. Right.
Yeah.
I don't think we're in that same situation right now.
We're not. I'm using
It's
this more.
different.
I'm actually using this as an example of the extreme, because what I was going to ask you to pull up next is if you could just Google this. I don't know how close we can get. I would love to see the average rental rate in America and the adjustments made between 2008 and 2012 as well. What I mean by that is if your wealth is totally tied up in the stock market or in single family homes, you took a massive bath for 5 years. Whereas as long as people were paying their rent, and most people still were able to do that, multifamily assets didn't really lose anything because they're businesses. They are determined by cap rate and NOI. My single family home absolutely lost value.
Yeah. If you sold it.
Yeah, if I sold it. But regardless, it's just based on comparables, right?
Yeah.
So my wealth, if I'm determining my wealth by my multifamily assets, that doesn't need to be affected by market trends nearly as much as my single family assets. Adjustable rate mortgages in the entire mortgage-backed security crisis blew up single family home values for a substantial amount of time, and that's real wealth. And you said, if you sold, there's people that had to put their lives on hold because they couldn't sell because they didn't have the equity to unlock it anymore. Whereas that would not be the case in multifamily as long as my business is still operating smoothly and people are paying their rents on time.
Yeah.
So look at this. Historical median monthly rents did not seem to drop at all between.
They went up.
They continued to go up. So
Well, your
All
demand.
those people that lost their houses needed
we
somewhere
needed to
to
go
live.
rent. So that's an extreme example of if there's a huge stock market correction, my thesis that rental demand may actually increase.
Yeah, so I agree with you. I mean, I think we're in a different time, right? But I think your core thesis around the market being overvalued and going into some sort of correction is very valid, right? And if we think about it in context of multifamily, 3 years ago, every multifamily deal being sold in Dallas was being sold with a going-in cap rate of 3%, right? All of a sudden this year, we're looking at going in cap rates of 6, right? Maybe 5s in some areas.
And if you can, for those if you're new to listening to this, cap rate means what?
Cap rate is the yield that you would get on an asset if you paid cash for it. So if you go out and buy $1 million asset and you pay cash for it, you would expect to earn 3% return on your cash. That was as of a couple of years ago, right? It's up to 6 now because things are a little riskier. However, right, there's an inverse relationship there. My point being that cap rates decompressed. So instead of having a 33x multiplier on your money at a 3 cap, the cap rate decompresses to a 6 cap. Now you only have a 16x multiplier. So your return is literally cut in half, right? Stock market trades on PE ratios for the most part, unless you're talking about, the stocks that Turkel puts us on.
Those aren't stocks. Those are gambles.
By the way, XRP is going up.
Is it?
Went up 20% yesterday.
Yeah, I know.
Oh,
It's
dang.
back to 60
I gotta
cents.
check my app.
Right.
I'm in at 80 cents though.
Okay.
So
So-
I'm still down.
If we see some sort of PE ratio recalibration, stock values will come down, but it doesn't matter unless you sell, right? It impacts your balance sheet temporarily, get all of that, but just don't sell. On the multifamily side, we have some sort of relationship with economic factors, interest rates, inflation, all that sort of stuff, right? But to Brian's point, if your rents and the overall economic health of your asset maintains, you may see a little bit of fluctuation, but that is more over the course of 18, 24, 36 months, not an hour
Right.
when the market opens. I was going to buy NVIDIA options Friday morning, and I was driving, and I saw it down like 14 points.
Yeah.
And by the time I pulled over, it was down 6.
Yeah.
I was like, damn it.
Yeah.
But multifamily just isn't that volatile.
It doesn't. It's not that. And Jesse's pulling this up right here. We're looking all the way back to 2006, really, all the way up until 2021. They've got a chart here. Wage inflation has outpaced rental inflation all but like 3 years.
See?
And part of that's 2008, 2009. And we're rents have been positive every single year. So even through the Great Recession, a cataclysmic global economic meltdown, rental rates still found a way to increase for unfortunate reasons for some people, because they were forced to rent when they would have otherwise been home buyers. But again, it goes to show, if I had the ability to put my money anywhere, I would way rather put it in a place where I know that there's predictable, steady growth than having to have my entire future hinge on robots trading NVIDIA options and you're watching my wealth disappear on a Friday afternoon.
I agree with you. But here's the thing that we haven't talked about yet, right? There's a lot of private investment that happens in multifamily. Institutions buy stuff, Lifeco buys stuff, BlackRock buys stuff. I get it, right?
It's 99% of trades.
Yeah.
Would
no,
be
I'm talking,
institutional, yeah.
yeah, no, I'm talking about on the multifamily side.
Oh, I'm sorry. I thought you were talking about the market. Yeah.
So I think the biggest risk to multifamily is that you have America. There is an investor community inside of America that's like, holy shit, I bought NVIDIA at 130. It's down to 104. The world is on fire, right? And your apartment deal looks great, but I'm going to wait for NVIDIA to come back.
Yeah.
Right? Who, to your point before, it took a couple of years, right, to rebound. I don't know if that takes as long as NVIDIA. So is the market volatility going to create some sort of psychological barrier or some limiting beliefs in potential investors? They're like, well, the market's too volatile. I don't want to invest in real estate, when in actuality,
you're a lot better off.
You're actually a lot better off, right?
Yeah.
Take some chips off the table, hedge your investments, and go earn some dividends while the market figures out what it's going to do.
100%. And this is a really fundamental investing philosophy. And I've heard a million times, I can't remember where I first heard it, is, the idea of putting good money after bad. You've got to understand, and this is very hard for most people to wrap their heads around, because we have this FOMO. We don't like to see our portfolios go down, and we want to hang on, we want to hang on, we want to hang on. Hanging on to a losing position or not cutting it off when it has further to fall is as bad as putting more money into it. It's just as bad as putting good money after bad. If I lost 20% on NVIDIA, especially, and this is, cycle specific, where we're at in the cycle right now, I might have taken some losses since Friday or since Thursday, but I'm up still. If I've been holding on to my securities or equities for any given amount of time, we've had a heck of a run for the last 18 months or so. So I shouldn't be down, right? Especially if I don't trade often, and this is long-term stuff. But the longer I hold on to a position that is losing ground, I might as well just be pumping more money into that position and losing it as well. So there is a psychological barrier there. And truly, that is what separates people from that are able to realize true wealth and freedom in their lives from people that continue to hope the machine takes care of them, knowing that it probably won't long term.
Yeah.
And that's, if you can get over that psychological barrier, you can take a hold of your financial life. And that's tough for a lot of people. I understand that.
Yeah. I also think there's like an asset allocation conversation behind this. I have never sold stocks to buy real estate.
Okay.
Right? Those funds have been purpose designated from day one.
Yeah.
Right? Savings were created to get to critical mass, and then you deploy capital. But I get that there's a sensitivity between trading one for the other. But I think you've really got to be very realistic about, to your point, is there an opportunity cost for me not to take chips off the table from the stock market and invest in multifamily?
Yeah.
Like Ray Dalio says this all the time. If you're down 50% in the stock, that stock needs to come back 100% just for you to get back to zero. Right? And there are stocks out there I keep harping on NVIDIA. I want to buy it when it goes down more, but like
He's putting it out there in the
somebody-
universe.
manifesting it. Yeah.
somebody bought it 137.
Yeah.
Right. That trade happened.
Mm-hmm.
It's at 104
Yep.
as of before the show.
Yep.
Right. And it's like,
So it's
You-
got to
you
rally
gotta come
30% to get back to even.
just to even.
Yeah.
Right.
And you've got to hope that's where you got to hope that the volatility works in your favor. But then you're just living and dying by the sword endlessly, right?
Yeah.
And you made a good point as far as, I'm the same way. I have never taken $1 out of the markets to invest in real estate. I have a certain amount of the earnings that I make that go into the markets every single month. I look at it. I rarely trade. It sits there, and that is a diversification.
I've sat next to you at the boardroom table.
I watch it a lot. I try not to make moves, but it's a diversification play, right? And so I don't move that money over. Now, I have been blessed throughout my career to be able to do both.
Right.
That is not true for everyone. And so if my only investment strategy is my retirement plan, I would rather be finding a way to transition that into real estate than keeping it all in the markets.
Mhm.
If you can do both, great.
Yeah.
Absolutely. Be diversified. I'm speaking to the person who hasn't hit that point where they're able to deploy more capital into real estate on top of what they're putting away for retirement.
Mhm.
I'd be finding a way to use that retirement account towards commercial or multifamily as quickly as possible.
Yeah. I mean, I think there's a lot of education that needs to happen there, right? Can you take a 401k loan, invest in some real estate, pay yourself back at a nominal interest rate over the course of 4 or 5 years? Do you have the job stability, right? If for some reason you are laid off unexpectedly, can you meet that debt obligation, so on and so forth? But there are definitely creative ways to do it. I don't think we do a great job educating people on those different solutions, right? And this is kind of a whole topic of a potential whole nother show. There's a lot of options out there that I don't think people take the time to learn about. And quite frankly, right, there's a lot of opportunities out there for people to invest in real estate that actually contradicts the big money market movers out there, right? Why would Vanguard or why would some of these big 401k providers actually tell people that when they're making fees off the money that you invest with them?
100%.
I had a good buddy of mine who's CRO of a high growth company, chatted with him a couple of weeks ago. He's like, send me your investor deck. I'm going to go talk to my financial advisor about it. Like, bro, why would he tell you to invest in our deals when he's getting 2 or 3% of all the assets you have under management with him?
Every financial advisor that my clients talk to has tried to talk them out of buying rental properties through our other companies.
100%.
So, I just sold stock back in July to buy a rental property all cash, right? Because it made sense. I was able to offset the tax gain from that with the offset and depreciation that I get from that rental property. And then now the cash flow's there and I'm walking into 80 to 90 grand of equity. So it's actually a better upside than that stock, the future longevity of the stock. And so, that makes sense. I think as we look at this as a whole, right, how stock market corrections impact multifamily real estate is that when we break it down, because the other side of this coin is that we need to have better financial education.
Oh yeah.
I'm reading the book. It's a workbook as well, Infinite Banking Concept
Oh
Theory,
yeah. I got it.
and really working that, because one thing, Matt, what you just harped on is having different options is we become our own bank. You go and fund your universal life insurance policy that allows you to then go and take that money to invest it in multifamily deals like deepbluere.com. And then from that, they're still earning money back on the money that was in their life insurance policy, because now they're becoming their own bank. It never truly went away unless they wanted it to. And then they can keep growing that. By the way, that's tax-free. When they do that, I'm not a CPA. You can go back and listen to episode, whatever that was, when we had the CPA guy on. Kiyoshi. And we're not worrying about the value of our deals because of the stock market. What we're worrying about is making sure that the expense ratios in the right place. We're worrying about delinquency and rent ups and lease ups and everything else like that. We're worrying about making sure that we're increasing rents that are not pushing people away, But at the same time, we still need to increase the valuation to stay on with our business plan.
Yep.
And so that's completely different rather than, I've sold all my stock. I'm actually completely out of the market right now,
Uh-huh.
which has been a long time since I've done so. And I used to look at it every day.
Yeah.
And
Yeah.
I don't think it's healthy.
I agree.
It's definitely not healthy. I
Yeah.
do it too much.
Yeah.
Dude, I definitely refreshed my Apple stocks page 24 times on Friday.
Yeah.
Waiting for a good entry point. I was like, I don't have time for this.
Yeah, 100%. And to make marginal gains. I mean, in the markets, I'm hoping for an 8% return, a year. I mean, I'd be happy with that, right? Whereas, it's not gonna show up on my app every single day, so I might not feel it in real time. But a solid multifamily deal is going to get you way better than 8% annualized return.
Yeah.
So it's more stable, way more resistant to market volatility when it comes to the equities markets. And if I can stomach the idea that I don't get a little electronic notification when I make $1, and I can do that mentally.
Do you really have it set at $1?
No, it's
Okay.
not. It's not set at anything. I check it enough without the notifications.
Yeah, the other thing too, I think the difference between investing in stocks versus investing in multifamily is, I feel like the stock market's very enticing to make very quick emotional decisions.
Oh yeah,
Right. When we're gonna make a multi-million-dollar investment in something, like the three of us go to war.
Yes.
Right.
Very true.
And there's no opportunity for emotional decision making.
Right.
I remember, I had a larger stock portfolio back in the day, and I was just like, should I buy this put option? Should I buy this call option? It's down $3. Should I sell? It's up $2. Should I sell? And all of a sudden I'm like, I got a job I need to do. I can't be toying around with this shit all the time.
It's gambling.
It is,
right?
100%.
And it's you're riding the adrenaline rush of gambling.
Yeah.
So and when we break it down, it's like, whether it's a downside or an upside, depending on how you're looking at it, and maybe your financial situation at any given moment, is that, investing in multifamily real estate is just not liquid. It's not a quick liquidity event, right?
Sure.
You're in it for 3 to 5 years,
Right.
Depending on the whole time. And so your money is tied up. Hopefully the asset is then paying the distributions, and sometimes it does, sometimes it doesn't.
Right.
I've had an asset that I just liquidated a couple weeks ago, and that one paid every quarter.
Mm-hmm.
And then guess what? Taxes and insurance in 1 year went up 41%.
Yeah.
The quarterly distributions started to skip. We had to make the tough call of saying, I'd rather have a conservative operating budget and account. And it started to dwindle that. Now the valuation didn't get impacted,
right?
That, as in that manner, but we were taking money out of our own pockets off the table right away, and then we just determined from that age of asset it was time to liquidate.
Yeah, and those returns accrued, and people made money still, and
Yes.
and it all worked out, and that's actually a really great example of how you have more options and ability to make a multifamily deal work long term and protect your investment than you do in the stock market. I mean, something like COVID, great example, happens in the stock market. You lose 30% of your value in 2 days back in 2020, which is crazy. And obviously it came back and then we all went on a large bull run. But you just made a really good point around how you have so much more latitude to operate a business that protects the investment than you do in the stock market. It's a fundamental premise. Even if you're not actively trading, if you're putting your money into the stock market, understand that whoever runs your 401k or your pension plan or whatever, they are up against other people every day in a very close to zero-sum game where their goal is to wipe them out and take all the money for themselves. It's very difficult to win long term on any large scale. I would so much rather give, like you just said before, put myself in a position where my strategic decisions benefit me and my investors rather than trying to trade against mostly robots at this point in this game that really doesn't have anything to do with the underlying value of the assets anymore.
Right.
Because the stock market doesn't.
Agreed.
I mean, the P&E ratios that we're trading at are bananas right now.
Agreed.
The
other thing is impactability, right? I don't know when the last time anybody who's watching the show like tried to go knock on Jeff Bezos's door and ask them how the business was doing.
Yeah.
Right.
Right.
Or say, hey, Jeff, I have an idea.
Right.
Or, hey, Jeff, you should be charging 9 cents more for Bounty paper towels on my Amazon Prime account. Right. There's zero impactability in the market. You're putting all your trust into the executives, product market fit, a ton of variables. Right, a ton of variables. And I think with multifamily or even real estate in general, there is a whole lot more impactability that can drive your positive outcomes. Right. Can you raise rents? Can you charge more fees? Can you cut your expenses? Is there, economies of scale that you can take advantage of? Are you in a market where there's a lot of job growth and that fuels resident retention and rent growth, right? All those different things. And maybe not everybody's got the stomach or the time for that, right? But if you don't, there are operators like Deep Blue Capital that understand all that stuff and fight every day to make those nickels and dimes translate to big dollars over time.
Yeah, absolutely. And the flip side, I'm not going to name names. There are examples though, and they're relatively well known for people that trade the markets, of companies that will purposely allow their organizations to go into bankruptcy just for the sole purpose of restructuring their debt, renegotiating with their unions, and then coming out with a better agreement on the other side for the executives more than anything, which obviously affects all of the shareholders. And if I'm holding that stock, I'm being manipulated by the people at the top. And my pension for whatever, my wealth is impacted by a purposeful drive down in price so that we can restructure an organization for the benefit of the few. And that is 100% happens all the time.
Absolutely.
It's the exact opposite from a fiduciary.
By the way, something I kind of was searching for here is eviction rates, right? So people, a lot of times people start to worry about, all right, stock market crash, we see unemployment numbers, increasing, job report coming in much lower. And they're like, all right, if I invest in this, like, what does eviction rates look like? And while, from 2008, if we look at that as kind of one of the worst case examples, 2008, the eviction filing rate was around 6.5%, with the actual success rate of that being about 3.11%, of all rentals. It did peak at around 2010, which was about 7%. Now, I just would look between 23 and 24. We saw from 22 to 23, we saw about a 10.5% increase higher eviction rate in 23 than we saw in 22. And then really the cities that we saw most, Houston, Las Vegas, and Phoenix, saw eviction filings increase by 43, 56, and 30% above pre-pandemic levels.
Wow.
Now, when we look at that pre-pandemic, I mean, it was kind of just smooth sailing. And then obviously there was no really evictions during COVID.
Right.
And then, just like the foreclosure moratorium, and then all of a sudden it was allowed to come up. So a lot of those numbers are going to be skewed off of that, but it said pre-pandemic. So, when you start working in your business plans of that, noticing that certain areas are going to have higher eviction, you just build it into your business plan.
Yeah.
And that's a great point when you build it in your business plan. And two, the other point to make there is, if we're looking at eviction as a function of value, meaning if I have to evict a bunch of people, the value of my asset drops because I'm not realizing that income and I'm taking it on as, potentially bad debt. I also now have a vacancy that I can fill again. When a stock drops, it drops. We've got something fundamentally has to change with the company for it to recover and then regain that footing. Every eviction also becomes a vacancy, which I can then go ahead and fill, and my NOI recovers immediately.
Yeah, that's the whole thing, right? It's way more influenceable. I trust us, me, you, Nick, even Turkle.
I like that guy.
Yeah.
Love you, Mike. To go out and put some Facebook ads on or ramp up our marketing, right? And put heads in beds. Like that to me is a lot of control and there's a lot of power in that. And quite frankly, when you're looking to amass wealth, that's really important.
Yep.
We have no ability to influence the performance of stocks unless you're on the board of directors of a company, and there's not a whole lot of people that get to those ranks.
Yeah, exactly. 100%. As we start to wrap up here, make sure that you head over to deepbluere.com, because if this conversation has not helped you realize why you need to go create your investor profile, learn about what we are doing over at Deep Blue Capital, I don't know what will. So go over to deepbluere.com, create your investor profile. We got more potential projects coming down the pipeline here. We'd love to get another great one in before the end of the year. We're working on it. We'd love you to be a part of it. Check out tourstudios.com. Go over and see the home of Jesse and make sure your multimedia needs are taken care of. Final thoughts on this one, boys. This has been a really good conversation.
I agree.
I think we can do like 5 more of these. We probably won't, but let's get what are our final thoughts? Do we think the market's going to crash and everything's going to go to hell? Or do we think we're going to be all right?
I don't think it's going to crash. I think you're going to see PE ratios normalize. I think you're going to see this AI bubble, if you will, shake out, kind of like what was it, the .com area, right, in the late 90s. And then we'll be right back to business as usual. The problem is we don't know what business as usual is, right? Because it's been so long. We ramped up quickly on COVID undone. Now we're in politically unstable times and elections and inflation and high rates and all that stuff. But it's just going to work itself out over time. Take a breath, be patient, don't sell unless you absolutely need to, and play the long game.
Yeah. And we didn't talk too much about this, but just kind of underlying fundamentals. GDP has still been solid the last couple of quarters, which is, if we're talking about recessionary indications, that's a big one. That's still been solid. Unemployment probably had to get up to where it is so that the Fed would be forced to start to cut rates again, which I think they should have started doing a while ago and maybe not even raised as quickly as they did in the first place. So all of these are ideas of normalizing, and it's going to take some time to shake out. There are going to be many more volatile days in the market, but all the more reason that I love what we do, because the volatility is minimized. I know I'm going to go buy some NFTs after this. I think those are coming back for sure.
Oh,
easy.
No, okay. I was like, I have one right now. I'll sell you. I think that as we are analyzing this, the problem is we're analyzing this in an election year.
Yeah.
Right. And
point.
so, I mean, election years, and this has been the most crazy election year probably out of all of them.
Comical almost.
Yes. Yeah, I see what you did there.
That's not what I meant.
Freudian slip. But, the real question, will be the test of time next year when we look back at this is kind of what we believe is that stand true and correct. Yep. And, I saw someone posting, yesterday, like, they went out on a limb and said, this stuff is going to happen. And everyone said this lady was crazy. And she's like, look, I put it out there and it unfortunately came true. I didn't want to be right. She's like, I saw this crash happening. I saw this. And the writing's on the wall. We had the party had to end, right? It's all fun and games when everyone's at a party having a great time and you're getting free party favors.
And then the cops show up.
Yes.
And I ID everybody.
Yes. And then you're running and jumping over fences and hiding in alleyways and everything else like that. And we're too old to do that now. So we get hurt. And so this is now time to be an adult. And we're going to get back to a working economy, whether we like it or not. And then from that angle, it's like the real estate investment portfolio, whether it's multifamily or single family, it's a safe investment in the long run. I mean, if we look at the values have continued to go up.
Yeah, we've got nothing but data on this. It's not really speculation at this point.
Rent has gone up, the valuations have gone up, and the only time that you're losing in a down market, or the only time you lose is when you sell in a down market. And more than likely, you were in some type of financial crunch that you had to sell. So we can't really say that it was bad. It's just unfortunately you had something some event that happened in your life that caused you to now have to liquidate. 100%. So I'm not too worried about it. I mean,
I'm excited for the future. I love the business that we're in. Excited to get more deals done, boys.
Let's do it.
Episode 51 in the books. Appreciate you guys. DeepBlueRE.com, tourstudios.com.
Leave us reviews.
Leave us 5-star reviews if you think we deserve it on Apple, Spotify, Apple Podcasts, Google Podcasts, wherever your podcasts are found. Leave us a 5-star review. We'd truly appreciate it. And check out number 52 next week. We're going to keep doing these live, it feels like. So feel free to chime in, converse with us during the show. We love talking with our audience. We will see you next week. Take it easy.